Welcome to another episode of Banking Transformed, the podcast that dives deep into the trends, innovations, and strategies shaping the future of banking. I'm your host, Jim Marous, owner and CEO of the Digital Banking Report and co-publisher of the Financial Brand. In this episode of Banking Transformed, we're thrilled to have Matt Harris, a leading investor and thought leader in the Fintech space and a partner at Bain Capital Ventures. As traditional banks, neobanks, and fintech firms continue to navigate an increasingly complex and competitive landscape, Matt's unique perspective and deep industry knowledge offer invaluable insights into the future of the financial ecosystem. With his finger on the pulse of the most disruptive technologies and innovative business models, Matt is a perfect guest to help us understand the current state of fintech and what lies ahead for the financial services industry. Matt also showed that success in this space requires a combination of innovation, adaptability, and a deep understanding of customer needs. It's clear that the world of fintech and digital banking is at an inflection point, with disruptive technologies, changing consumer expectations, and an evolving regulatory landscape all converging. The financial services industry is poised for significant transformation in the years ahead. So, Matt, you've been with Bain for almost 12 years, and you've had a front row seat, to say the least, to the rapid evolution of the fintech landscape. What do you see as the most significant changes, certainly in the last few years, and how these changes really shape the future of financial services from your perspective?
Well, Jim, first of all, thank you for having me on. I've wanted to talk to you for many, many years, and I'm honored to be included in your podcast here. The thing that's causing the most waves right now, frankly, is the regulators. We had evolved to this architecture where you had fintechs doing their thing. You had sponsor banks of various types underneath who were actually bearing the regulatory burden, holding the cash, things that only banks can really do. And then you had these middleware companies that are generically kind of known as banking as a service companies. And that architecture, which underpins much of the payments innovation, the lending innovation, the banking innovation that we've seen, has now been called into question by regulators and is being kind of litigated as we speak.
So, when you look at that, and, we talked before we started the podcast that we've seen the venture capital markets go up and down. And that's, I guess, normal evolution with anything. I mean, it was really hot for a long time. But as you said, the regulators really, they're learning as they go, it seems, many times. And it's not going to stop because right now, we have, you've been quite noisy on social media lately about regulatory situations, particularly related to, as you mentioned, the sponsor banks. When you look at regulatory and compliance as a grouping, what trends do you see happening there? And why don't you explain a little bit about why it's so important? How do you see regulatory changes changing, maybe impacting the growth and adoption of fintech solutions, but also really changing the relationship between traditional and non-traditional organizations?
Yeah. So for years, basically, there was this understanding that regulators were good and comfortable regulating financial institutions and wanted nothing to do with regulating these technology companies. And so the sort of implicit bargain was that the Fed and the FDIC and the OCC would just keep regulating banks, and through them, they would sort of indirectly regulate the fintech companies who were built on top of them. And meanwhile, they would do everything in their power to keep new licenses from being issued. Yeah. So that was sort of okay. So they would allow for innovation through this indirect regulation model. And I think everybody wishes they would just issue new licenses and allow for the creation of new dynamic banks. But okay, that's not going to be possible. So fine, you can let innovation happen indirectly. And what they've come to realize is that that is insufficient control from their perspective. I think SVB and the rapid migration of deposits enabled by all the technology-driven connectivity, it was really embarrassing for regulators and a wake-up call. And so the summer after SVB, the summer of 2023, there was this interagency guidance issued that said we're going to look much more closely at these third-party relationships, and that those chickens came home to roost this spring with a bunch of ugly letters being issued to this population of sponsor banks saying you have insufficient controls. You don't understand what these fintechs are doing and who their customers are, and transaction level monitoring through these middleware companies of the end users. And the regulators are correct. In fact, there had not been at the level of the sponsor banks sufficient visibility into who the users were and what they were doing. And so we're, in the middle of a painful transition process where basically relying on these middleware companies is not going to work, where if you're going to be in the sponsor bank business, you have to have a very sophisticated tech stack so that you can understand exactly what's happening with every end user. And that adjustment is going to be painful, and it's going to drive some number of banks out of the business of being sponsor banks.
So where do you see this evolving to? I mean, it's not right now. It's pretty much the sponsor bank, the banking as a service, realm of that. Where do you see this actually ending up impacting other areas? Because obviously the whole tightening around the whole industry, is it going to continue this way? Is it going to get tighter?
Well, I think we do need to recognize this is an impactful problem. If you add up the users at Chime and MoneyLion and Dave and all of just the B2C retail banking competitors that are non-banks, these so-called neobanks, it is tens of millions of Americans who are getting at least some degree of their banking services from non-banks today. And so if we pull the rug out from under that entire system, life is going to get worse for tens of millions of Americans who've chosen to work with these companies instead of a traditional bank. And there is a real risk of that. So far, none of those larger entities have been disrupted. The real disruption has happened with the customers of this company, Synapse, this middleware company that has gone into bankruptcy. But the way things work in banking, as someone who's observed it for decades, these things happen in waves, and it could easily be that the next wave that happens is a real chilling effect on this entire community of sponsor banks and a deplatforming of all of these non-bank retail banking providers. And so I think my hope is that sober heads prevail. The regulators realize that there's real consumer value being delivered, and they work hard to not disrupt this entire ecosystem. I think where this ends, Jim, to your question, is with a bunch of much more capable banks providing sponsor bank services. So, this idea that you can have kind of an unsophisticated sponsor bank that basically just has a regulatory license and all the work being done by a Synapse type middleware company, that is gone. If you're going to be in the business of underpinning a Chime or a MoneyLion or a Dave or frankly even a payments company, not a sort of retail banking company, you need to be sophisticated. You need to have your own technology platform, and when the regulators come in and ask you,
answers.
You need answers. You can't say, "Well, let me get Synapse on the phone." It has to be, "Oh, the transaction you're worried about that took place in Seattle at 524 at the gun shop. Yeah, we can look at that. Yep, that owner was of the appropriate age, and we authorized that transaction, and here's why. Not, we'll get back to you." So where this ends, I hope and believe, is with a new crop or an upgraded crop of sponsor banks who are properly in the business of managing third-party relationships in the way that correspondent banks have done since time immemorial. This is not actually brand new, but it will represent a maturity of the segment, and my hope is that can happen relatively quickly.
So it's interesting. Taking the other side of that, you mentioned neobanks. It's been a hot topic, obviously, in the fintech world, and many were promising to disrupt traditional banking. But it's interesting is as they evolve, they start to look more and more like traditional banks, but with just brand new names. Also, we've seen that many, especially in the slowdown caused around the COVID time, many have really struggled to achieve profitability and scale. What are the key challenges facing neobanks today? Is it the investment marketplace? Is it, the fact that they were living off some of these investments as opposed to building businesses in the old-fashioned way? How do you see the neobanks environment changing, and how do you see them addressing the challenges they're facing?
One question that you ask is, how did the neobanks end up in the situation they're in? And one reason is there was very undisciplined funding.
Right.
And you can look to venture capitalists, of course, for this. But during the period of zero interest rates, when you had this incredible buoyancy around everything to do with technology, there were billions of dollars deployed into neobanks without a lot of questions being asked and answered about the fundamental business model. And that was true in many sectors of technology. So we can't just pick on fintech or neobanks, but it was certainly true in neobanks. And what that did was it meant that customer acquisition costs just skyrocketed because you had dozens and dozens of entities being funded to, in effect, compete with each other to acquire customers. And obviously that increased the cost of those customers. The other thing it did was create way too many entrants, often who are very narrowly focused on a psychographic or a demographic or some segment that I think a more skeptical observer would say, boy, that's really not big enough to build a big enough business to cover all the fixed costs that are inherent in being in the financial services industry. So you had, mistakes made of those two types. But as we sit here today, if you zoom out and look at the global picture, neobanks have taken real market share. I mean, Nubank, public company traded in the U.S. market, but half of Brazil literally uses Nubank, and with north of 100 million customers, wildly profitable model. And they've become a regulated bank in Brazil and on their way to being one in Mexico, and they will create a collection of global licenses. Revolut in Europe is similarly massively multi-billion dollars a year of profit with incredible pace of innovation. And customers are voting with their feet that they preferred Revolut to Barclays and other sort of nationally focused banks in Europe. In the United States, there are fewer and less obvious sort of hero companies, particularly with that kind of profit profile. And that's because, in my view, you've seen two approaches that haven't really been synthesized. One is really a DDA focus, so Chime being the largest of these, where they have reached some level of scale in terms of number of customers and revenue, but not profitability. And to me, that's quite obvious because they just don't have lending. And you really have merely half a loaf if you're going to be a retail banking company that doesn't have the profits engine that comes from lending. And on the other side, you've seen companies like MoneyLion and Dave, both of whom have seen tremendous stock price performance in the last 12 months, but still are predominantly lending companies without a great story around deposits. And the reason for this sort of you only have the left half of the brain or the right half of the brain approach is that none of these entities are banks. And so they can't leverage their deposits into lending. They're just two different businesses unless you get the banking license that allows you to bring together the cheap funding of deposits with the beautiful profits that come from a lending business. And so you can understand why they grew up only doing one or the other. But to me, that points to the future, which is look at what Nubank has done, look at what Revolut has done, get a banking license, buy one, apply for one, put those deposits to work in lending products with the unfair advantage of having already acquired the customer, having all the data that comes from owning their DDA, leverage that unfair advantage to actually serve them with the lending products they need.
But even Varo's had. I mean, they have the banking license, but even they've had challenges with scale. It becomes a matter in the U.S. at least. Are customers going to be willing to make them your primary financial institution? Because even though you offer it, doesn't mean people are going to come and use everything you offer. We've had trouble with people transferring over to the other side of the business, be it from deposits to lending or lending to deposits, with the exception maybe Lending Club and a couple others. So it's very interesting. When you're from a venture capitalist perspective, beyond just the neobank and the fintech company, what are you seeing that's interesting right now? Where do you see? Is it the payments area? What are you funding? What is being funded in the industry?
The most important theme right now is the implications of generative AI for financial services and not least of all for retail banking. What's being funded right now are basically vendors. So these a new crop of technology companies that are springing up to serve banks and serve financial institutions more generally to help them with digital transformation as it relates to generative AI.
Yep.
So you could think of chatbot companies as being sort of a, probably the most advanced wedge on this, and customer service more generally as a way to introduce generative AI, lower OpEx, and create more customer delight. So that's where a lot of the energy is. My own view is that in the long run, or even the medium run, generative AI is actually an existential threat to retail banks. In the short term, they can use it to lower costs here and there. But the question I always pose to banking industry leaders, CEOs of banks is, what are you going to do when all of your customers have generative AI? Because if your customers woke up tomorrow and did the thing that was in their best interest, they would almost certainly leave you because you're never paying the top interest rate on their deposits. Your whole model is about making a spread between what you can get away with paying them on deposits and what you can get away with charging them on loans. And so if everyone optimized and they could do so without inertia, the retail banking industry would be in trouble. And in my view, that's what generative AI is going to allow for in the future.
It's interesting. We just had Financial Brand Forum, which is our organization's collaboration or getting together the retail side of the banking world. And it's interesting because I think it was 2018, I'm guessing here, we started seeing the vendors meeting with vendors at the same time they were meeting with banks. It was very interesting because they started seeing this whole solution matrix, these organizations that are helping banks be better what they do in a way that was very composable solutions where, financial institutions no longer were going to try to rip out the core and start over. They were going to work with these partners, and the partnerships have gotten pretty strong and the solutions have gotten stronger. But you're right. With generative AI, there was talk in this year's conference that, when I asked the bankers in the room, how many of you have closed a major financial institution relationship with your primary bank in the last 5 years? Nobody raised their hand. Now, mind you, it's a very biased audience, and that they're all bankers who work at a bank. But then I asked, how many of you have opened a new relationship with a non-traditional or a fintech company in the last 2 years? Everybody raised their hand. And that's that transformation, that customers are actually moving away from traditional financial institutions in a very silent way because they're not closing their accounts. They're not doing it the old way, but they're opening new relationships that are fulfilling all these different service needs. And as you said, when you get when you have a consumer that has their own generative AI twin, and you maybe have a financial institution, some type of financial institution that's doing the same thing, then banks become very generic. They're only a place to hold money. They're not a place to do banking. They serve the holding of funds, but without even a vault. It's a very different world than what we've had in the past. And you really wonder how many organizations get it, for lack of a better term, and are doing anything about it. It's just, it's a different world.
It is. And, so much of the banking industry, their competitive advantage over time has been geography.
Yeah.
Back to the sort of branching laws that prevented too much national competition for many of these banks. But, we have 4,500 banks in this country, most of whom exist because there's a local community that needed serving. And that is not a durable basis for competitive advantage in the future. It really isn't even one right now in the world where you have national digital competitors, whether they be Chime or JP Morgan Chase.
Right.
So I think banks have figured that out. And the more interesting thing to me even is actually, you make a great point. The vendors have figured this out. I think even the core vendors who take so much criticism. I mean, just last month, the OCC was criticizing the core vendors for not allowing innovation. But the fact is that all of the core vendors have done much better in this regard in the past 2 years than in any 10-year period that I've been observing. Jack Henry investing in their Banno product, Fiserv making an aggressive acquisition. I think FIS spinning out payments so they can focus more on banking software, bringing in a dynamic executive to run that business. I mean, everywhere I look, the cores are getting the joke more and more that they need somewhat of an open architecture to allow the Q2s and the Alchemies and the other digital experience companies to serve their shared customer base, but also improving their products and, stemming off the core replacement trend that seemed to be picking up steam 2 or 3 years ago. So I think the vendor landscape has gotten much more interesting. And I think the banks will ultimately be far better served if they choose to stay with their core, or if they choose to insist that their core allow for other vendors, to create digital experiences that are more innovative and novel. In either case, I think the banks will have better options than they've had in the past.
And it'll really come down to who will make those purchases or make those partnerships work. We saw all these solution providers. You could pick the best new account opening experience. You could pick the best communication experience. You could pick the best back office onboarding experience and all these elements. And if you actually did that, you're going to be much more future ready and resilient than the organizations that I say, and that's from my perspective, I see it being those middle-sized asset ranges that are stuck between not having enough money to invest like the Chase and Bank of America's, but even more importantly, not having an innovative group of leaders that allow them to move quickly to build a composable solution organization. Unfortunately, but also fortunately, the banking industry is not seeing a losing year. You don't see banks not making money. So they get stuck on the status quo because it doesn't feel broke, even though, organizations like your own say, you know what, I got to find those that are going to move the organizations forward. And it's not a traditional financial institution. So it's going to be interesting to see how it plays out for sure.
Yeah, I think there is a powerful inertia in banking, in part, as you note, because they continue to make money in every environment, and in part because the regulators ask hard questions about any change in their technology stack and otherwise. And so that inertia, even if the logjam is breaking somewhat and there are new vendors with new solutions and the cores are getting more supportive of innovation, I do worry that it's all fighting the last war, as the banks finally get their act together in terms of these more sophisticated customer engagement methodologies, the customers are just going to be using generative AI agents. So all that engagement investment won't mean much when you're facing off against, as you say, a digital twin that's doing the work of banking on behalf of customers.
And the customer right now, I know myself and yourself, we're almost building our own open banking ecosystem ourselves. We're picking whoever, from each category, what we want to be our partner to move forward. And the banks aren't keeping up. I mean, I'm dazzled by the fact that I continue to have money taken out of both of my financial institution relationships going into Acorns, and yet neither organization has ever offered me an alternative. And they see what's happening. I mean, it's not invisible. Or when you look to buy a new car or a house, there's all kinds of signals that go out there, and there's no response from the traditional players. And you go, I have a lot of options. And again, as I said earlier, if you don't, there's no typical way of closing an account like you used to do 20 years ago. So you can look like you're feeling, fat and happy and doing everything right, and all of a sudden realize you've completely lost the relationship. It's a big threat. As is, shifting a little bit here is a very obvious segue, is around embedded finance, because that takes it completely out of the traditional banking system as we know it. What do you see in that area? What do you see in the whole embedded finance area, and how will that work out compared to what we thought would be maybe 5 or 6 years ago?
Well, I think, where embedded finance has taken hold most dramatically is in the small business category. Yeah. And there it's been very dramatic. I mean, if you consider vertical by vertical, look at restaurants, look at e-commerce sellers, obviously you have massive penetration of companies like Toast and Shopify, where 70+% of their base are doing their payments acceptance through the software company in question. But the same is true across, we have a company that's in auto repair, and they have practice management software. And if you're using AutoLeap to run your auto repair shop, you're definitely going to use them to take payments. They're started at 10%, then they're at 30%, and they will end at nearly 100% penetration of the auto repair shop saying no to the brick on the counter and instead taking payments acceptance through the practice management software. So that is, particularly as it relates to payments acceptance, merchant payments, that train is running exactly as we expected. And we're seeing more penetration on the procurement side as well. So more and more of these software packages are introducing card issuing and helping these cards do their spend, helping these small and medium-sized businesses do their spend on embedded finance cards that are procurement cards within their software so they can buy their inventory, et cetera. Payroll is increasingly being included in these packages. So I think phase one of this, which is small and medium-sized businesses adopting payment solutions in particular through the software that they use to run their business, that has a head of steam. And lending is a part of that. And this is where I think banks need to be careful is, if you're lending money as a bank to a restaurant that uses Toast, you really need to be asking yourself, like, why didn't Toast offer the loan? What does Toast know that I don't know?
Well, and they do know. In some cases, I look at, I've told this many times on my show that, my business bank is PayPal because I do all my payments through PayPal. I get my receipts through PayPal. And what ends up happening, they know more about me. So they're offering me the bridge loan, not my traditional bank. And if I went to my traditional bank, it would take weeks if I'm lucky. And I'd have to go into a branch and nothing's simple. And on the other hand, I can push one button and get the loan. And, we look at, I remember banking when financial institutions used to have reps that went out and gave the little, pin pad, the credit card acceptance thing. We've given up all the data. The banking industry no longer has access to real data. Yes, 45 transactions went in or out of by PayPal. And, oh, by the way, the rest were done by Amazon. And you know nothing about me. You don't know what I buy, what I do, how often I do these things. You just see transactions. And it's, I think, when you look, especially in the digital world, the data is where the business is. That, as you said, if Toast isn't going to give that organization a loan, as you said, what do they know that I don't? Or on the other hand, if they see a really good partnership, what's to say they aren't going to take over that relationship from a credit standpoint?
Yeah, and I think the sleeping giant in the space is Intuit,
Yeah.
who just in the past 12 months has made some very aggressive moves in payments to, they have all these transactions. They are, in many cases, the actual source of truth as it relates to data about a company. And they're in a very logical spot to disintermediate both accepting payments and issuing payments, and then obviously lending. They've had a half in, half out relationship with payments and lending over time, and that's all changing now. So I think Intuit on the small business side, and then all these vertical players, and on the consumer side, Apple is incredibly well positioned. They are the system of record for high end and middle market consumers in the United States and globally. And they also have an incredible merchant footprint because of the iPad, because now of soft point of sale technology that they've pioneered. So they really are this incredible sleeping giant. They're on their own. They're moving very carefully to build a complete wallet that has your driver's license now in 17 states, digital driver's license, and obviously cards of all sorts. And so I think brick by brick over the next couple decades, Apple is going to continue to put themselves in a position to take over and own the data and ease of use for consumers. And it'll just be when they decide and how they decide to take more and more of that profit pool. And that is a major risk in retail banking. I think for the middle market, higher middle market and enterprise, that's still a relationship banking business. We're seeing certain cases around treasury where treasury software packages are enabling things like hedging, things like optimizing interest rate, certain tools around foreign exchange, getting incorporated into these tools that CFOs and treasurers use. So disintermediating some corporate banking. But that's going to happen much more slowly. Where we're seeing real dynamism is in the small and medium-sized businesses. And then with a consumer, with companies, as you mentioned, Acorns, most of my banking life is on Acorns now. I've got accounts for each of my kids. They're saving and investing, and they're all not real accounts. It's my account, but the subledger technology, no bank can offer that level of user experience so far that Acorns offers me. And all my bank knows is that there's money moving to Acorns multiple times a day.
Oh, yeah.
So that's where we're seeing embedded finance actually really turn the banks into these dumb pipes, which they do not want to be.
Matt, you mentioned Apple. And you mentioned the whole idea of the tech companies really having a powerful role here, as well as other organizations such as Acorns and others that use banking simply as a funding mechanism or a transfer mechanism, and that people, consumers, small businesses, big businesses, keep on using more and more of these technology tools. So when you look at technology today, what do you see with things like artificial intelligence, blockchain, open banking APIs, as far as playing a role in the way that consumers and businesses interact with their financial institutions, but also when you're looking at innovation and better customer experiences?
Yeah, so I think when we think about the risks to banks, I think the biggest risks do come from these so-called big tech companies. Fintech has nibbled away at the edges, but big tech, in an era where generative AI becomes the main playing field, the resources required to be on the cutting edge of generative AI are unprecedented. Facebook has said publicly they're spending $15 billion on chips alone this year. Just to keep making progress on their open source, quasi, semi-open source, large language model, Llama. And there's just no bank, not even JP Morgan with their technology budget, who can compete in the arms race to stay at the cutting edge of generative AI. And generative AI is one of these technologies, unlike blockchain, where it's actually immediately affects the customer experience. The magic of going onto ChatGPT and interacting with it as if it was a human being, or seeing it generate audio and video and text in a way that seems downright human, maybe even superhuman. But these are very powerful customer experiences. It's not some back office technology like the way enterprise blockchain, it didn't even fulfill those expectations, but
Right.
the way that it was promised to be in terms of settling transactions, et cetera. So I think the threat to banks coming from big tech, heavily funded, extremely focused, large technology companies like, I think the most dangerous are Amazon and Apple.
Yeah.
Because Google and Facebook and Microsoft, they really do want to serve these banks. These banks buy a lot of advertising from Google and Facebook. Yep. They buy a lot of technology from Google and Microsoft. Amazon now with the cloud platform is slightly conflicted, but I think they'll be aggressive in consumer financial services. But the company that doesn't care at all is Apple. Apple owes no allegiance to any bank and will be, I think, over time the most disruptive. Tokenization. Jim, I want to return to your point about blockchain. Blockchain has been something that banks can safely ignore since its inception. It really has been largely a kind of a crypto asset class phenomena. Consumers may be interested in owning Bitcoin or owning Ethereum, but banks don't really have to be in that business. And it's been safer for them to stay out of it. And until recent, legislation, they've actually been prohibited from custodying these kind of digital assets. And all the enterprise blockchain, it was just sort of theater, basically. There's not been a use case that's proven to be useful. But I think I would submit that stable coins are the first real innovation that banks, I think, should be paying attention to, because they're growing very quickly. In the first case, they're being used mainly by consumers outside of the United States who, for the first time, have an easy-to-access U.S. dollar-denominated instrument. So if you're in Venezuela or in Argentina or in Nigeria, and you can use a crypto wallet, which right now it just has Bitcoin, Ethereum, whatever, and you can add USDC and start keeping your savings in dollars in a very easy, very liquid way. That's been a very interesting technology for people outside the U.S. And now that BlackRock has introduced a yielding stablecoin, so that it's really a money market fund, but it's much easier to get in and out of, and you can, again, keep it in a crypto wallet. You can start to see where wallets that keep tokenized assets become very appealing as a comparison with a bank account. You can, actually hold the assets yourself versus having some counterparty risk with the bank, and you can get Fed funds rate at all times with instruments that are also spendable. And then as we introduce more real world assets that are tokenized beyond just money market funds and US dollars, instruments that are more interesting, higher yielding instruments, maybe even equity-like instruments. I think the future of financial services for consumers over the next 5 and 10 years will include these tokenized assets and savings instruments. And so now I think banks have to start paying attention to tokenized assets, maybe not tomorrow, but over the next 5 years.
Right. So, Matt, we don't talk enough, but it's always interesting to see where the marketplace is going. What excites you about the future? And I'm probably talking 3 years down the road, because none of us have proven very good at looking 5 years down the road anymore. So what excites you right now?
The thing that excites me most right now is crypto, actually, which is a very contrarian position to take. But the innovations I'm seeing, and again, mainly benefiting consumers outside the United States, the innovations I'm seeing where it's a true democratization of cutting-edge financial services that can be delivered at this incredibly low cost, low latency, and low friction to anyone, anywhere. That's why I got into fintech in the first place, Jim, going back to the late 90s. I just felt to me that all this friction and extra expense and bureaucracy was getting in the way of providing this vital service to the people who needed it most. And there have been many attempts to serve the underbanked with prepaid cards. I mean, none of it's worked. And I finally see in crypto, and it's funny that it's happening first in Nigeria, not in Manhattan, but we're finally seeing real solutions that are much lower cost and much higher efficacy and better financial outcomes for people who really need it. So to me, I think the next 10 years, crypto is going to be not the speculative, messy, fraud, driven, corrupt thing that it's been for the last 5 years. It's going to be this democratizing, liberating force that's going to really spread financial services into corners of the world that haven't seen it. And that's what I'm most excited about.
Matt, it's interesting. It's great to talk to you. I've seen you speak many times. It's great to have you on the show. It's also a great time. We talk about the threats. We talk about all this change that's happening. It's the most exciting time in banking ever. I mean, when things were running at 0% cost of funds. It was certainly interesting back then, but you couldn't put your finger on what's going to actually happen and which companies were really going to survive. But I think we're getting a good feel for, you still got to run a business. Monzo was another good example we didn't talk about where, you got to give some credit to the organizations that were started by a lot of bankers that were looking at new banking ways of doing things. So we'll see what the evolution of banking really becomes. But I really appreciate you being on the show and taking some time to talk about your view of not only the future, but also looking back a little bit and saying, here's some things that didn't work out as planned. So appreciate your time, Matt.
It's been a real pleasure, Jim. Thank you for having me.
Thanks for listening to Banking Transformed, the top podcast in retail banking and the winner of 3 international awards for podcast excellence. We appreciate your support. If you enjoy what we're doing, please take some time to show some love in the form of a review and share the podcast with others in your firm. This has been a production of Evergreen Podcast. A special thank you to our senior producer, Leah Haslage, audio engineer, Chris Fafalius, and video producer, Will Pritz.